In the 5+ years of doing the daily financial news, I think I've been late less than 10 times. Well, we are on the road just for a couple of days, and when you travel and you hate flying and you don't sleep, you don't sleep. So I am late today. But don't worry, folks, we've got 2 pages for the daily financial news, and I wanted to give them to you as soon as my brain wasn't foggy. So let's get into it. The big news of the day is we were going to get a non-farm payroll adjustment. This has been coming for quite some time. There have been estimates that the adjustment would be as low as about 300,000, potentially as high as 1 million. What does this mean? Well, in essence, it means the job market is not as strong as we think. Now, we also got the actuals. The actuals came in at 818,000 less jobs than expected. What does it mean? Well, you can think about this in a couple of different ways. The first way I think about it is 818 divided by 12 is roughly 68,000 less jobs every month than was forecast. For example, folks, I believe last non-farm payroll had jobs up 118,000, something like that. The one before that, I think, was 323. Again, think about each month being 68,000 less than expected. That's point one. Point two, and probably the most important point, what does this mean for the Fed? Well, I expect the market to look at this and saying, hey, the anchor that you have been banking on, the job market, is not as strong as we think. In fact, it's about 30% less strong than we thought. What do I mean by that? The last 12 months was reported at 2.9 million jobs created, and now it's more like 2 million jobs. Again, 2 million jobs, still healthy growth, but it's not 2.9. So is this enough for the Fed to say the job market is weakening? We have a dual mandate, price stability and full employment. I think the market is going to say yes. Just for grins, I got the largest adjustment was to professional and business services. It saw an adjustment down of 358,000. Again, what does this mean for the Fed? Obviously, we are going to get Jerome Powell's Jackson Hole presentation in a couple of days. We're also going to get the Fed meeting minutes here in a couple of hours. I will be interested in both of them for different reasons. The Fed minutes, we need to remember, is a 6-week look back. What was the Fed talking about? We know that the Fed came out and gave 100% agreement, no rate cut, no rate increase. I suspect, and we will see in the Fed meeting minutes, it wasn't as clear cut as they said that week. And again, the meeting minutes will show that. Also, we are going to start to get clearer and clearer camps about who is ready for a cut and who wants us to hold tight. Then we're going to get Jerome Powell. I believed this whole time that Jerome Powell should go into Jackson Hole's speech on Friday as a hawk. That is looking less and less likely. Let's just call it how it is. Good old Jerome Powell just had his one last anchor, the jobs market, get a 30% haircut. I'm not sure that he can be as hawkish. So the market is already 80% expecting a 25% rate cut, or 25 basis point rate cut, with the other 20% being 50. That is a 100% chance of a cut. It is getting more and more likely, but as I always do, I will stay on he's going to go one meeting longer than he should, and then he's going to be forced to go 50 in November. This is either going to be a legendary call, or I will once again look like a fool. That's okay. I look like a fool all the time, but the Jackson Hole speech on Friday is going to be interesting. Next up, we have a lot of stuff going on about the economy, and I think you need to look at these statistics and try to get to the deeper level. First off, it looks like the steel industry is in for some trouble. The steel industry in China is in an economic winter. If you guys don't know, obviously China's economy is struggling. They're not doing nearly as much building as they were. So you are seeing China steel rebar down 20%, iron ore down 28%. What does this mean? Well, it likely means China is going to start dumping, right? What does that mean? They have excess supply. They need to get rid of it. You are going to see them dumping into other economies. You may see tariffs. You may see things. The other thing, the kind of second order derivative I am watching is export economies, specifically Australia. Australia is an export economy and has done for the last several years a robust business with China. What might this mean for the Australian economy if their exports are in for an economic winter, to use the headline from the expert? So that's something I'm looking at. Let's talk about a lot of retail, man. Woo! A lot of retail earnings came out. Let's talk about it. Target beat top line, beat bottom line, but did issue a cautious outlook. Sales were up 3%, and they highlighted discretionary items. Looks like discretionary spending is back at least a little bit at Target. Next up, TJX. TJX, home for Marshalls and Home Brands and other discount retailers. They beat top line, beat bottom line, and raised guidance. So, folks, I always ask myself, are we in for a trade down, right? Are people trading down from, say, Macy's to Target, from Target to Walmart, from Walmart to Dollar Store? These are things that I ask myself. So, what did Macy's do? Well, Macy's cut sales forecast as the department store struggles to draw shoppers. So, are we in a trade down cycle where the consumer is still quasi spending, but they are going to more discount or value stores? I don't know, but that's what it certainly feels like. Let's talk about Toll Brothers. Toll Brothers, housing, interest rates up, demand down. How the heck could Toll Brothers, a luxury home builder, do okay in this market? Well, the answer, folks, is in one of their names, luxury. Toll Brothers, if you don't know, is the luxury big builder. I would argue that their home buyers are less interest rate sensitive than the average person. I don't think that's unfair. I would think the average Toll Brother is putting a significant down payment and thus aren't interest rate sensitive. They are also probably to a greater number buying for cash. So again, Toll Brothers beat top line, beat bottom line, raised guidance. Now, does Toll Brothers' success mean folks like KB Homes, Lennar, Pulte will also be killing it? No, I don't think that's fair. I think we are in a K-shaped economy, a bifurcated economy, where the top 20, maybe 30% are doing phenomenal and everybody else is struggling. So again, if you are going to sell to a home builder in this kind of economy, you want to be at the high end, the luxury builder. Plus, you want to be new build, not existing. I believe we are seeing a huge divergence between new builds and existing for one reason and one reason only. Builders can buy rates down. When mortgage rates are 7.5% or 8% for existing home sales, they can be 5, 4.5. Shoot, they can be 4% if the builder wants to absorb the cost of the points to buy the rate down. On top of Toll Brothers, we also got Lazy Boy. Lazy Boy, depressed traffic. They did beat top line and bottom line for the quarter, but issued very weak guidance. So again, lots of trouble going on with the consumer. How about Lowe's? Lowe's, we got Home Depot last week. Lowe's warned consumers slowing down. Comparable same-store sales 3 to 4% lower. You know what, folks? I actually want to give an economic, lesson or vocabulary here. Obviously, Lowe's is warning of consumer slowdown. They are highlighting that consumers are interest rate sensitive. They're not spending the big money. But I ask you, what if we are just seeing the ramifications of less existing home sales? Obviously, folks, new homes, when they sell, they don't need to be remodeled. They don't need to be updated. But we have gone from 7 million existing home sales to sub 4 million, and we've been here for quite a while. So maybe, just maybe, what Lowe's and Home Depot are suffering through is not demand destruction, which is what would happen with higher interest rates and less demand. What they're actually seeing is just a normal remodel cycle. You do less remodels if you're selling 4 million than 7 million. You also need to understand there's this thing called demand, push, and pull. What did we do the last 2 or 3 years and the pandemic? Well, most of us remodeled our home. You added a deck. You did something. These are capital projects that you don't do every year, and I would argue you might do once a decade. So if we spent 2 or 3 years pulling forward demand, that leaves a vacuum or gap or air pocket in future demand. So I'm not sure. I'm not buying this interest rates are higher nonsense. It's probably important at the margins. I'm more like, guys, we're selling less homes. We're doing less remodels. Why are you overcomplicating this? Well, we got some updates from some Fed speakers. Now, keep in mind, all of these things I'm about to read were before the 818,000 reduction in jobs. We go first to Fed President Neil Kashkari. It is appropriate to discuss cutting rates as early as September because of the weakening job market. Folks, again, he said that before we lost 818,000 jobs. How about Fed President Mary Daly gaining confidence that inflation is returning to our 2% target? All right, folks, how about Fed President Raphael Bostic? Rate cuts are coming sooner than I would have thought before. Again, I remind you that that was said before we lost 818,000 jobs. All righty, folks, we're going to talk about some tax policy. We're going to talk about unintended consequences, and then we're going to wrap up this fun video. And again, I apologize for being late. I apologize for not being live, but we did get it done. We did get it here, and I hope you're having a great day. Let's talk about a tax policy of unrealized gains. Folks, now I understand that this policy currently positioned to only impact folks over $100 million. Something you should know about our federal government and tax policy is once they implement it, they will quickly start lowering it. So let's talk about unrealized gains. You own a home. This is just an example. You own a home. You bought it for $100,000. After a decade, it's worth $500,000. An unrealized gain would be the IRS coming and tapping you on the shoulder and say, hey, buddy, you owe me taxes on that $400,000. Now, like most of you, you don't have, an extra $100K lying around if the tax was 25%. I know I don't. I don't want to write a check for $100,000 because my home went up $400,000. But if you are getting taxed on unrealized gains, what happens? Folks, that will introduce what is called forced sellers. If you introduce forced sellers in illiquid assets, it will destroy markets. Now, homes aren't necessarily illiquid. I'm not saying that. But when you think about unrealized gains, I want you to think about small businesses, medium businesses. These things can be worth lots of money, and they are not liquid. It's not like you can go on your Charles Schwab or your favorite Webull or your favorite, trading platform and sell 25% of your company. You don't want to be a forced seller. So tax on unrealized gains is a disaster waiting to happen. How about taxing the wealthy? Hey, you're worth $1 billion. Here's an extra 3, 4, 5% tax. Well, folks, ask California, ask New York, ask Chicago. These are 3 areas where there is high income taxes. And what happens when capital is not treated right? It leaves, it moves. If you haven't seen the data from New York, from Chicago, from California about the rich leaving, you are not paying attention. Whether you like it or not, the rich are mobile. They have options. And if you start singling them out for an extra tax, it would not be impossible. In fact, it would likely be probable that many of them would just simply pick up and move to where capital is treated better. Now, what would this do to economies? It would likely destroy many economies because when you have billionaires leave for other parts unknown, they are going to take all of their businesses, services, and things with them. And then finally, folks, let's talk about a 50% tax on capital gains. Yes, there is a proposal. I think it's for 46%. I just want to say, I don't normally agree with Grant Cardone, but Grant Cardone is absolutely right in this example. If you level a 50% tax on capital gains, which would happen when you include the state level, federal and state, what you're going to get is no sales. People who have equity positions, the rich, the wealthy, the 1%, they're just not going to sell. You know who has to sell? The middle class. The middle class, when they've seen their run up in their stock, they have to pay for college. They have to pay for a home. They have to pay for this. The rich, the wealthy, they won't sell. They have options. They will simply go to a lender, pledge capital, and borrow money. You are seeing this today with art collections, with private companies, and the like. They are simply raising debt. Debt is non-taxable. So again, folks, when you look to attack wealth via taxes, you are going to get tax policy and tax behavior that you may not expect. Again, folks, I apologize one more time for not doing this live, for missing our 7:30. I want you to know it is important to me. But sometimes when you are traveling, sometimes when you are sleep deprived, it is absolutely the right answer to catch up on your sleep and talk to your people later. I hope you have an amazing day. Like, subscribe, comment. Have a wonderful day. Bye.